So we're going to cover Chapter 6, Data-Driven Fraud Detection. And I'm not a specialist in the IT portion of the forensic accounting. In fact, in the graduate certificate in forensic accounting that we offer here at George Mason, you can take courses in the Masters of Computer Forensics program in the engineering school. In fact, in the engineering school, there's a former FBI agent who's a CPA, but during his time at the FBI, he got heavily involved in information technology. I'm using information technology to detect fraud. And so that's a big part of forensic investigation. And so if you want to improve your employment opportunities, then take courses in the Masters of Computer Forensics program. Because there's a lot of people who know information technology, and there's a lot of people who know auditing. There's not a lot of people who can do both. And the firms need people who can do both, because a lot of auditing, not just forensic accounting, but actual external audit relies heavily on the IT auditors who can audit the system. And so if you have any inclination to learn the information technology side, then I would encourage you to do it. In fact, at George Mason, we're looking into offering a certificate in IT audit that would be similar to the certificate in forensic accounting, but it would be for people who wanted to get into the IT audit side, because all of the firms need somebody to do that. So I'm going to refer you to the book on some of these things. But related to Chapter 6, I also want to refer to the Albrecht and Dunn lecture, because the authors of the textbook also wrote an article in the Journal of Forensic Accounting about some proactive fraud detection they did at an oil refinery. And so I want to talk about what they did there as an illustration of what you can do in proactive fraud detection that we're going to discuss here in Chapter 6. So what we want to learn is to discuss the importance of data-driven fraud detection. And we'll talk about the difference between accounting anomalies and fraud. We'll talk about the data analysis process. And we'll also hopefully become familiar with some common data analysis packages. And we'll talk about other things like open data, database connectivity, basic database analysis, metasosis matrix, and then we'll understand how to analyze financial statements, which we've already talked about vertical and horizontal analysis. But I'm going to put up some slides from McGraw-Hill as well relating to horizontal and vertical analysis that you can consider. So related to data-driven fraud detection. This is give an example of what you can do for database queries. There's an example here from North Carolina of a university employee of 30 years who discovered to provide a social security number of a dead person when they originally applied. And so what somebody did eventually is they got the Social Security, a database of Social Security numbers that are outdated because the person died, and they matched it up to employee databases at the university and found that there's several people at the university who had given fake Social Security numbers. So again, these are using data-driven fraud detection methods. So we'll talk about these things as we go. The one thing that external auditors are really good at is uncovering anomalies. Anomalies are just mistakes. So when people make mistakes, the mistakes are just random. And when external auditors do a sample, nobody's trying to hide these random anomalies, these random mistakes. And so they're pretty easy to find by taking a sample of a database, and then the errors will sort of stick out. And if you take a sample, you don't find any errors, then the population is likely not to have very many errors. But if the population has several errors and you take a sample, you'll identify those errors, and then you can, depending on the error rate, you can increase your sample size to continue to find errors. So anomalies aren't very hard to detect because nobody's covering them up. But fraud's different. Fraud's intentional. So it's oftentimes very hard to find the fraudulent transactions because they're being covered up in some way. And so just taking a bigger sample is not necessarily going to uncover the fraud. The example they talk about in the book is like finding a needle in a haystack. And so rather than take samples, what forensic accountants do, because now computing power is so great, they can analyze big data. And the new thing you hear about quite a bit these days is big data analysis. And so they can actually take what these forensic accounting firms, or even the big four firms or the regional firms that have a forensic accounting division, they'll take the whole general ledger for a particular company and just sort it for things that they think might be suspicious. And so they sort the whole thing looking for that needle in a haystack. And they don't want to just randomly select specific journal entries to look at to see if there's errors. They want to look at journal entries that they think are going to be the suspicious ones. So they'll sort it by journal entries, for example, that were made maybe by non-accounting personnel or made by people who don't normally make journal entries, like upper management, and the time of the day when they made the journal entries. So if the journal entries were made late at night, they're manual journal entries by the controller or the CFO who doesn't normally make journal entries. They want to look at all 100% of those, right? All those journal entries. So they'll get the database of journal entries and they'll sort it looking for those types of things. So they'll have searches for sort of suspicious journal entries, and they want to look at all of those. And so looking for fraud is different than looking for errors. And external auditors tend to be good at finding errors just by increasing their sample sizes, but they traditionally have not done a good job of finding fraud because people are trying to cover it up. The other thing that's important to do, and that's why I want to show you this example in this oil refinery, is it's important to be proactive in your data analysis and not just wait until you get a tip from somebody that maybe somebody in the firm is committing fraud. And so it's important to, and we'll talk about these things as we go, but think about the methods that people could be using to commit fraud and brainstorm about those potential methodologies that they could be using to commit fraud. And then what you do from there is you identify, okay, if they're doing it, what would be the red flags that I would see? And then you use your software tools and data analysis tools to see if those red flags show up or manifest themselves in the data. So there's no reason to wait until you get a tip or wait till there's a whistleblower. You can do these searches on your own. An internal audit would be helpful just to do these on a regular basis because they know where the potential fraud schemes are in the organizations where they work. And if they're worried about that their buyers are getting kickbacks from their vendors, there's certain searches that they can run, on a regular basis to see if prices increases are occurring for products that they buy, that appear to be abnormal. And so if they're looking for these things on a regular basis, they can detect fraud before it gets big. So the 6 steps to being proactive is first you have to understand the business. And if you're internal audit, you're a forensic accountant, you probably understand the business pretty well. But if you're external auditor, you come in, hopefully you have a pretty good understanding of the business because you've audited in the industry. That's why they hired you probably, because you know the industry fairly well. But it's still one of the first things that you do when you go in as an external auditor. Or even if you're a consultant coming in to investigate fraud, you're going to walk around the facility and talk to people that are there and try and understand, okay, exactly how does information and products flow through this organization, right? Because that'll help you brainstorm and understand what are the potential weaknesses and where the fraud could be. So we'll talk about sort of each one of these things as we go. Understanding the business, identifying possible frauds, how to catalog symptoms using technology, and then analyzing results, and then ultimately performing and concluding your investigation. So we talked about understanding the business. We're going to tour the business, the department. We'll walk around. One of my clients, when I was an external auditor, was a rock quarry, and they just dig granite rock out of the mountain, and they had these big crushers that would crush the rock up. And one of the first things that I did every year is we walked around, we toured the facility. I went up on the crushers, I saw what they did. I had a hard hat that they gave me with my name on it. But help me get familiar with the process and how they move rock around, what exactly the business does, and I get to know key personnel inside the organization. And then I also look at what competitors are doing and see if what they're doing is consistent with what I know about the industry. And then we're going to talk about analyzing the accounting information and other things, but a lot of understanding the business is discussing with personnel within the organization and then observing them performing their duties. And that'll help you identify if it's a large organization, for example, they have good internal controls. If it's a small organization, then are there other issues like a lack of internal controls? Does one person make all the decision making, and going through that process will help you identify where the fraud could occur. Then it's also helpful to break the business down into its individual functions. Like at the rock quarry, they really had one function, which is to produce the rock. But you could be at an organization that sells hardware, they sell software, and they have different business functions. So it's important to identify what exactly each function does and what are the controls around each one of those functions. And who are the key players in the business? How do they do the reconciliations? Right? So it's important to look at how does the company break their business down. And usually they break it down by business function. So if they have multiple different types of functions, like a Marriott hotel, for example, they're going to have the large hotels, then they're going to have their hotels for smaller customers that are like Embassy Suites type hotels. And so, he asked the client, how do you break down your business, right? What is it that you look at? And sometimes they might break it down by geography. They might have domestic versus international sales. And then developing who the insiders and the outsiders are in those spaces. And then identifying these possible frauds, then that's when we start to brainstorm and think, what are the types of fraud could be committed against this company or on behalf of the company? Could they be bribing government officials to get contract work from the government, right? Or could their vendors be colluding with, or could your buyers be colluding with their vendors and getting kickbacks? So think about the fraud that could happen. Could employees or management acting alone commit fraud? If you think about management fraud, which is fraudulent financial reporting, are there only a few individuals who are responsible for external reporting such that they can manipulate the financial statements? Right? If it's employee fraud, is there good segregation of duties, or could one individual potentially steal, embezzle from the company, and then cover it up, conceal it? So think about, could vendors or customers act alone, or could they act in collusion? And so thinking about all these things will help you identify and brainstorm possibilities for ways in which this company could be committing fraud. And then cataloging the fraud symptoms. Once you have a list of potential fraud schemes that could be perpetrated against the organization, then you sort of break it down and say, okay, if somebody were to be getting kickbacks, for example, so you have a situation where your buyer is getting kickbacks from the vendor. So if you think that could potentially be happening, what are these of these 5 groups would have red flags that might suggest this type of activity is going on? With accounting anomalies, it may be that you have vendor invoices, and on those invoices you see either lack of purchase orders or purchase orders that don't have approvals on them. So your buyer you're the buyer and you're contracting with the vendor's sending things over, and or you're sending your purchase orders over to them without getting them approved by anybody above you. But that would be an accounting anomaly, because you look at the documentation for the purchase order you're sending over, and when auditors go look at that copy, that purchase order is not being authorized, or they're buying at prices that are not on the vendor's approved price list. So are there any internal control weaknesses? So maybe there's internal control weaknesses that's such that price increases have to be approved. If a buyer has to buy more product at a price that's above a standard price list, then is there approval from a manager? And if that process isn't even in place, then there might be an internal control weakness. So that might be a red flag to the auditors that this kickback scheme could actually occur because there's no approval process for price increases. There could be analytical anomalies. That's where you see actual increases in returns. So if a buyer and a vendor are colluding, and the company's vendor is is colluding with the buyer, then ultimately what they want to do is raise prices on their products regularly, knowing that the buyer is going to buy regardless. And they'll also start sending over inferior products. So analytical anomalies would be unusually high price increases. So you might look for products that have price increases greater than 100% over like a 3-year period, or for products that have an unusually high number of returns because they didn't pass inspection when they come in. Of course, you might look at their buyers and like, have any of my buyers bought new cars or bought a new home? Are they living an extravagant lifestyle compared to what we know about them? Are they exhibiting any other unusual behaviors? Right? Are they irritable when they were normally calm? Are they normally pleasant individuals and now they become irritable? And so looking for behavior changes are also important. And then obviously tips and complaints. If somebody points out that they're aware, they heard the buyer talking on the phone to the vendor, and they were talking about kickbacks and other things, and they provided a tip. Of course, those would be fraud symptoms. So red flags for kickbacks, like we talked about, increasing prices. And when we go through the example in the oil refinery, we're going to see some of this. Larger order quantities. So your buyer was buying from several different vendors, and now they're making large purchases from one particular vendor. And so increased purchases from what appears to be this favored vendor, and you're not buying from other vendors. And then also decreasing quality. So products coming in and it's getting rejected because of the poor quality. So behavioral symptoms. Does the buyer relate well to other buyers and vendors? So do they have a good rapport with the people that they work with? Right? Have their work habits change unexpectedly? Are they all of a sudden working at night so that people don't hear when they're talking on the phone? Right? So looking for changes in their behavior. Lifestyle symptoms, they appear to be living beyond their means. And later on we'll talk about doing some analysis to determine if somebody's potentially living beyond their means. Some net worth analysis and other things. But are they buying a new automobile, a new home with no subsequent increase in salary that you're aware of? These would be red flags. And just because a buyer buys a new car doesn't necessarily mean that they're committing fraud. However, if you're thinking about, okay, could they potentially be committing fraud, you're going to be adding up the red flags. So the buyer is also irritable, is working at night, is buying new and expensive clothes and a new car, which you didn't anticipate. Right, and then there's also products that they buy from are increasing in price rapidly, and they're increasingly buying from one vendor. Well, if all those red flags start to add up, then it's the higher likelihood that this buyer is involved in a kickback scheme with a vendor. So control symptoms, some other things. All transactions with one buyer and one vendor, and maybe this vendor is not an approved vendor, so they haven't been. This vendor hasn't been vetted by your buying department and approve them, because to get an approved vendor, you want to make sure that their prices are consistent with the industry, that they have quality standards. And so you have a buyer buying from if a buyer is capable of buying from a vendor who's not on an approved price list, that would be a red flag related to controls, that control is not in place. The document symptoms is 1099 from vendor to a buyer's relative. So maybe your buyer's wife is getting paid by the vendor for services that they're not performing, right? And so they get a 1099. And that's how the kickback is getting funneled to the vendor, is maybe through the wife. Maybe they've hired the wife as a consultant and they're paying the wife, but not actually requiring her to do anything. That's how they're getting the kickback to the buyer. So, things like that. That would be a documentary symptom that would suggest a kickback scheme is in place, be a red flag. Obviously tips. So people call up, complain about a relationship. That would be something that you'd want to consider. So tips and complaints sort of go without saying. If somebody's trying to tip you off to a fraud, of course that's going to be a red flag. So then how could you use technology to gather the data that you want? And so the first off, if you want to do these searches like we talked about, you want to search the general ledger to find out, are they making manual journal entries that are performed in the middle of the night by individuals who don't normally make journal entries, like upper management? Well, you'd have to find out what database is the company running. Maybe they run Oracle, right? And in which case, where on Oracle, right, on the system that they're running, what is the database that houses all the journal entries themselves? Right? And then from a standpoint of looking at those journal entries and being able to sort it, you have to be able to get the database that houses all of these journal entries into a software package that you can use to analyze and sort. And so what you need to do is get that database, find out what they're running, and then get it into a language where you can sort it. And that's where we're going to be talking about. And this is where I don't have a lot of experience, but if you maybe in an undergraduate audit class who used ACL. Most of the audit firms use ACL as a way to sort big databases. There's another data analysis software called Caseware's IDEA, and it's similar to ACL. Some people prefer it to ACL, others prefer ACL, but this is a data analysis software package, both of these, that, for example, if you were ever to pull off of Oracle all the general ledger, all the journal entries, then you'd be able to do the searches, using the software package, and identify those suspicious journal entries that you want to look at. Right? So you need to be able to get the data off whatever package they're using, whatever software package they're using, into a software package that allows you to do the searches that you want to do. So Microsoft Office has Active Data Platform. So it's a plug-in for Microsoft Office that allows you to do similar things that ACL and IDEA do. It's based in Excel and Access. It's a little cheaper to get that, but for larger data sets, you might want to use ACL or IDEA. You can also use SAS or SPSS. These are statistical analysis programs. I use SAS to analyze data. Like if I'm going to look at companies that committed financial statement fraud and compare them to companies that haven't, I get a database called CompuStat, which is just all the financial information for all publicly traded companies. There's a big database company that gathers that data. I import it into SAS, and then I merge it with a database that I have of companies that I'm aware of that have committed fraud. That way I have their financial statement data for these companies that committed fraud, and then I match it with competitors of similar sizes using total assets and other things, and then I can run in SAS, I can run statistical packages analysis to find out if firms that have committed fraud or have any unusual activity, any unusual fluctuations, for example, in their financial statement analysis. So I'll use SAS to do that. That's another data analysis tool that a lot of people use. So the key is getting the data into a format that you can actually use. So when I run in SAS, I pull the data directly from CompuStat, and CompuStat puts it in a format that SAS can read it. But if you want to get all the journal entries from another, from an organization, because you want to sort it and look for suspicious journal entries, you have to find out what format the company used and how can you get that format into a software package that the software package will recognize that format and be able to sort it and look for things that you think are suspicious. So one method is open database connectivity, and looking at this in the book, this is a methodology by which you can take data from one software and import it into a statistical analysis tool. And oftentimes, if you can store the data in a text format, especially as tab delimited text, most database software analysis tools can sort a database that's in text format. And then, if you work for a big firm, or even if you work for the FBI, there's going to be data warehouse storage places where if you can get that data into this data warehouse, then the tools and everything are available to you at the firm to do those searches. So again, open database connectivity. I'll let you study this and read the book, but there's a lot of information related to how to use this to get the data directly into the software package like ACL that you want to use. I'm not going to test you. I'm going to give you test questions about open database connectivity and how it works. So there's not going to be any technical questions on the test. I just want you to have a general idea of what you do with data analysis and how you can be proactive. And so, consequently, like I said, with text, if you have tab delimited text, it's pretty easy for most databases to read, and you can import it directly. And then if you get it into a data warehouse, then you can sort of automatically, and that's the ideal situation. You can analyze the data using ACL or whatever data analysis package that your firm wants to use. So the interesting thing the way to look at this data analysis, there's a lot of different things that you can do, a lot of different sorts that you can do to look for this suspicious activity. The first thing you want to do is get the data prepared such that you can import it. And then you can use Benford's law. Now, Benford's law, and this is, I'm going to give you some links to watch some videos about Benford's law so that you can get handle some short videos. But basically, interestingly enough, is that for naturally occurring data, like financial statement information, when I say naturally occurring, that's opposed to like Social Security numbers. Social Security numbers are not naturally occurring numbers. They assign you a number, especially like the first 3 digit depends on where you live. So naturally occurring numbers are like the length of rivers, the population of cities, the page numbers in books, because they start from 1 and go up, where Social Security numbers don't. So naturally occurring numbers follow Benford's law. So, for example, if you're looking at populations of all the cities in the U.S., the probability that the population size, the first digit in the population size is a 1, is much greater than the probability that the population size starts with a 9. So, for example, the city is more likely to have a size that's in the millions, like 1 million, than it is to be 9 million. That might sound a little strange, but if you think about it, you have to start with 1. So a city's going to have 1 person first, and that 1 person, that's going to be the first digit. So then it has to double in size to go to 2, and then it has to triple in size to go to 3, etc., and then to 4, and then to 5, and then to 6. But it started off at 1, and then if the city dies, it never gets to 9. Right? But if it gets to 9 people, then it goes to 10, and then it starts at 1 again. Then it doesn't get back to 9 until it gets to 90. And then it goes to 100, and then it starts at 1 again. So it's most likely that because you have to pass through 1 and then 2 and then 3 first before you can get to 9, it's most likely that the population size is going to end before it gets to a 9. And so that's why in naturally occurring numbers, you're significantly more likely to have a 1 in the as a first digit than you are a 9. And the reason why that's helpful in fraud analysis is that people don't understand this law. And so if they're making numbers up to try and fool auditors, then the first digits are more likely to be 9s, or there's going to be an equal chance that there's going to be a 9 in the first digit as there is a 1. And so you can find distributions of numbers that look made up if they don't follow Benford's law. Like I said, I'll put a couple of videos up that you can watch. They're just short videos that explain Benford's law and how to use it for forensic analysis. Now, the thing to keep in mind, though, is Benford's law is not really that helpful unless you have extremely large data sets. And so the way it would be helpful is if you were looking at, for example, one vendor that had thousands and thousands of invoices that they send to you on a regular basis. Then you can sort their invoices by, in the thousands. If you'd have a vendor that just has 2 invoices, the probability, you're not going to be able to use Benford's law to identify this unusual string of numbers. You need the string of numbers has to come from a very large population for it to be helpful. But it is helpful if you are using a population with you're looking for fraud in a population with large numbers. So we'll talk about digital analysis, outlier stratification, and sort of all these things as we go. And then once you've sort of identified, where these anomalies are, then you can put a mitosis matrix together that says, okay, in this case, there's some concerns that maybe there's some bid rigging going on in this example. So the first contract is 10 or 100 to 221, and it's direct corporation, and there wasn't a lot of red flags related to that bid. And so you can sort of sort it by potential red flags. And then if you see contracts that have multiple red flags that look suspicious to you, then you sort of know where to look. So putting, like in this case, contracts into this mitosis analysis helps you identify all the potential red flags. So they've identified potential red flags, they've sorted it, and they can look at by contract and see if they see anything suspicious. So that's helpful. And then like I talked about, I'm going to put up some analysis related to financial statement analysis, related to vertical and horizontal analysis. Now, you did a lot of it for FS1, and you'll do more of the same for SS2, but that's looking at data across time and then within accounts, and then calculating key ratios and comparing them from period to period. So calculating like debt to equity ratio, comparing that across time. And then it also helps you when you're analyzing the financial statements, and doing your data analysis is to look for, it may be useful to stratify your data. So we talked about earlier, if the business has multiple business functions, you might want to look at the financial statements for each individual function, or for each subsidiary. So stratifying the data may be helpful to identify fraud, because you might have unusual fluctuations that you don't pick up because they get lost when the financial statements are compiled with multiple business functions. But if fraud's occurring in one of the business functions and you're able to stratify your data or your financial statements for that one business function, then the fraud's more likely to stick out, right? And then also, you want to look for as the slide earlier said, you want to look for outliers. So you want to look for the potential unusual fluctuations that just don't look right. And even if you're not looking specifically at financial statements, but you're looking at price increases, for example, across your products. Of course, you want to look at the price increases that appear to be outliers. So the prices that are increasing by 5% a year may not be suspicious as the price increases that are 100%. So you might want to stratify your data or sort it and rank it, and then look for the items that appear to be outliers. So all these things will help you identify potential red flags that would indicate that a company is committing financial statement fraud. So now I want to talk about this Albrecht and Dunn article to give you an example of all these things that we've been talking about.